So guys, welcome and thank you very much for coming today. This is a workshop, which means we work. So we're not here just to listen to me drone on, if that's okay. What I've always experienced is that lawyers have a deep relationship with their clients. But what I think you do as lawyers is that you don't use those relationships appropriately in terms of trusting yourselves to provide more and additional proactive services to them. The context for which you should be looking at strategy within your business is your business planning. This is what we call financially well organised model. When we talk a bit later about product definition, this is our product. This is how we work with our clients. And part of that is around developing your business plan. And your business plan is simply working out where you are now, where you want to get to, and then how you're going to get there. And as part of your business plan, there's 5 key areas: getting clear on your business context, why it exists, understanding how decisions get made in your business, making sure you have strong financial management systems, how you drive your revenue, and then how your business is led. So today we're going to be talking about your revenue strategy and focusing on what you need to be doing to drive improvements in your revenue. Squeezing the orange. Squeezing the orange is what I see in nearly every professional services firm. When you squeeze the orange, what comes out of it is juice. So eventually when you squeeze the orange as much as you can, there's going to be no more juice that you're going to be able to get out of it. And so what happens to the orange when there's no juice in it? Just sort of shrivels and rots and dies. So what squeezing the orange is the revenue formula that's used by most firms. And what happens with most firms is they spend all their time doing the work. They're 95 to 98% or even 100% of their effort goes into the production and delivery part of their work. It's what they focus on to drive their revenue. And then occasionally there are some other ad hoc revenue activities that they do. A little bit of marketing, calling a referral partner, or ringing the bank manager and taking him out to lunch, or catching up with the insurance guy, but very reactively. And what they do is they build their budgets on an annual basis using this formula. How many full-time equivalents they've got, fee earners, what their available hours are, times how many hours those fee earners can charge, times a charge out rate, a recovery rate, so how much of it actually gets billed, take off what it costs them to pay for that labour, and that gives them a gross profit. They take their overhead out of that and be left with hopefully a profit before a salary to the principal, and then hopefully some profit after that. This is very important in a firm, but if it is the methodology you use to generate your revenue and it's the only methodology, then what it does, it creates a whole lot of behaviours in your business that are the opposite to what you need to be doing to grow and improve your businesses. So what this formula does, it drives behaviours that have got nothing to do with driving your revenue. What this formula is about is measuring whether or not you've got enough capacity to be able to do the work. This system was invented originally by the accountants for measuring the cost that it takes to generate revenue. What I'm saying to you is what the behaviour is that this formula produces is everything that is opposite to what you need to be focusing on in your business to drive revenue. This requires people to do 2 things. Stay behind their desks and charge hours, because if they're not charging hours, they're not generating revenue. And it requires them to take longer to do the work so that you can bill more. But whether you bill more is then a question of whether or not it actually happens. If you want to generate additional revenue in your business and you want to keep clients happy, good customer service and efficiency, speed of work. Mind you, you've still got to make sure the quality's there and it's the right advice and you're professional and so on. But the only way to have good customer service is to get up from behind your desk and go out and talk to people. Go out and build relationships. So what this does, it stops that. And this is why law firms struggle with growth. This is why accounting firms struggle with growth. This is why town planners struggle with growth. Because you sit there and charge hours. And then the GFC hits. And what happens when the GFC hits? People do this. They just keep their hands in their pockets and stop spending money. And then what do? We sit there and wondering where we're going to charge our next hour from. Whereas if we had processes and systems in our business that were out there driving that revenue and finding that revenue, there's still revenue to be made because there's still law firms earning revenue, even in tougher times. It's just about how you get your hands on that. I prescribe that this is the formula that you should be using, because as an accountant, this is what sales, how you make up sales. This formula here is the formula that every business uses in the world, including yours. You use this now, but you just don't focus on it. How many clients do we have? Plus how many new clients? So how many clients are we going to service over the next 12 months? How many times do those clients work with us? How much do they spend with us each time? Then how efficiently can we do the work, and what's the cost of reducing that work that gives us our gross profit? How many of you focus on new clients more than existing clients for generating work? The joy of the hunt. Yeah, people only generally get divorced once in a while. Understand. Family law. But if you're a firm that does family law and has got other services, then there's other needs that those people can have. So how many clients do we have? How many times do they use us? What's the average sale? There is a wealth of opportunity in your client bases for driving additional revenue. But you don't access it, you don't tap it. But by setting your targets using this as a method, and this is a formula, what it does, it then hones your thinking into what are the activities I've got to be doing in each of these areas to produce these results. Because this is the formula that actually creates the revenue line on your profit and loss. It's how many transactions did we do this month by what average sale value. It's not how many hours did our team charge at what rate and what do we recover, that gives us our revenue. Ultimately it comes to the same number. This is basically our profit and cash flow planner that we use with our clients. So we get them to, we have a look at their numbers, break them up into these areas, and then use this as the basis for how we develop budgets for the next year. So I'm just going to use these numbers and put them in here because we're going to come back and look at this. Later on from a cash flow perspective as well. So we've got 4.24, and what we're going to do is going to increase that by 4%, so that this particular firm is looking at an additional 170 new clients for the year. Going to increase the transaction frequency by 10%. So that our matter numbers go from 860 to 984. So we've got 124 new matters for the year. And our average fee is we're going to increase it by 15%. Because despite what the world thinks, you guys don't charge enough. Hallelujah. Despite what you think, people like to pay more. inherently there is, with the right client, and it's getting those right clients, inherently there is an alignment between price and value. If your price is too low, they don't value it as much. By driving the additional revenue here, they're going to need some more labour costs, so there's another $80,000 in direct labour, and they've got some additional overhead costs of $60,000. In this particular firm, we said that the profit originally was $530,000 before principal salary, therefore. They had $150,000 of principal salary each with two principals, putting an earnings multiple on that for valuing the firm of 2. Now, I've just picked that number out. Some people will say it's 1 time, some people say it's 3. If you're a seller, it's one thing. If it's a buyer, it's another, so I'll pick somewhere in the middle. So that gives a value of $460,000. But if this firm could achieve these results of getting their revenue up to $2.2 million by only 4%ing 170 new clients in a year, 2 partners, that's 85 new clients each, if you do it that way. By getting an additional 124 matters, and by increasing the average sale by 293. So only going from 1953 to 2247. What are those things that you're doing in your business that are actually driving your average sale down? What are the services that you're providing for $400 and $500 that drives your average sale down? So what are you doing to drive your average sale up? Sometimes it's what you're doing that actually keeps it down. With these adjustments for this firm, that produced an additional $390,000 of profit if they could achieve these numbers. And in achieving those numbers, what it does, it increases the value by 780. Because the value of any business, I don't care if it's a law firm or if it's a franchise or a distributor, every business is valued on the same principles. What is the risk to the buyer of returning that same profit next year? So if you've got systems in your business that drive revenue and profit improvements, then your value's got to increase. You know, that's often what we don't think about. What's the value of my business? It's actually the best asset that we've got that can produce the greatest amount of wealth for us, not just from an income earning capacity, but from a value of sale. Your biggest asset to grow that you can actually control is your business. You can't grow, you can't control your passive investments. You can't. But what you can control is the profitability you make in your business, because it all comes down to what you actually do. So in this particular firm, they're not going to go and put on any more people. They say, we've got 6, that's enough. What we're going to do is we're going to drive an improvement of 5% in our productivity. So we're going to implement some activities. We're going to implement some activities that are going to change. We're going to change what our fee earners do and what they don't do. Who's got their fee earners collecting debtors? Honestly? Thank you. Yeah. Worst debt collectors in the world. And principals are second worst. Okay? So if they're spending their time and energy worrying about collecting a debtor, what are they not doing? Charging hours. So if they're not charging hours, what are you not making? Yeah. Provided you've got the work. Okay? So, looking at what fee earners do and what they don't do is the way of improving productivity, not by saying charge more hours. We're going to change our charge rate here, and we're only going to add an extra $25 an hour to our charge rates. because we are too cheap. Okay, so we're still going to measure how we're going to do this work via our hours basis, but we're too cheap. And then what we're going to do is we're going to have the guts. Going to have the guts to bill everything that we charge in WIP. Who calls it a discount? And then they write their WIP off. Some people call it a discount. Yeah? Anyone call it a discount here? Discounters. Crazy Clarkers, where are you? So what happens in businesses is that a system gets created and a process gets created in most businesses to deal with the minority, not to deal with the majority. And then what that does, it permeates through the business so that that becomes a normal system. So this is why we write off. We write off because a small number of clients have complained about their fee. It's a small number of clients complain about their fee. So why do we write off a lot of the time? But the best way to manage your revenue is what you do at the front end. It's not what you do when you send the bill. The more effort you put in at the front end, the easier it is to hit your revenue numbers. It's the activities, it's the focus that you have in your business of how you drive your revenue and how you create your revenue that actually stops you generating your revenue. So if we can remember back about the squeezing the orange, it had two components to it. It had your production and delivery work, which is where you're spending most of your time churning out the hours. Then there was this ad hoc revenue activities, a little bit of marketing here, phone call there. This is what a normal revenue strategy should include. First of all, it's about your product. You've got to understand what your product is. So your product is what you sell. The most unprofitable businesses, legal firms in the world are general practitioners because they have no product definition. I'm not saying you have to have one product and that's all you do. You don't have to have one, just a single specialist firm. You can. But firms that try to do everything do nothing well. They might be great lawyers, but they do nothing well. So the key to driving your revenue growth is to first understand what your product is, okay? And the more defined you are on your product and what you do as a business, the easier it is to let your clients know what you sell. If you're very clear on what your product is, then the message that you get, the message that you're able to get out there is so much clearer. And the clearer your message, the easier it is to sell. But we don't do anywhere near enough time, spend anywhere near enough time getting clarity around our product. We don't spend anywhere near enough time producing definition and content so that people can understand what we do without having to ask us. So sales is the only activity, is your only strategy in your business that can impact both your revenue and your margin. But do we spend a lot of time focusing on our sales strategies? No. So if it's the only thing that drives your revenue and your margin, but we spend all of our time purely focusing on doing the work, which can only drive our efficiency and impact on our margin, then no wonder we're going to struggle to drive and improve our revenue. Because once you focus on a margin strategy, you'll get your greatest improvement once off. And then every improvement from there is just marginal. Where your revenue is unlimited, it really is, depending on your actions that you implement. So what we've got here is what I call the revenue matrix, and what it does, it overlays these two principles. So first of all, as I said before, sales is the only area It's the only plan that impacts on every aspect of revenue and margin, right? So sales impacts on your client numbers, your transaction frequency, average sale and margin. So if you want to generate new clients, you've got to focus on marketing and sales activities. It doesn't matter what your product strategy is for driving new clients. You've got product there already. If you want to get more people in the door, you've got to market and you've got to sell to them. You can't have a client relationship management system for new clients because they're not clients. How did you guys all come to be here today? At some point in time, I marketed to you. Okay? If you want to increase transaction frequency, all of the areas except production and delivery, because production and delivery can only impact on margin. It's only about efficiency. So you've got to develop strategies in product marketing, sales and managing those relationships so they keep coming back. If you want to increase your average sale, you've got to focus on strategies that are product marketing, sales and client relationship management. If you want to improve your margin, focus on your sales and your production and delivery only. But your margin is going to be limited there because if you're not increasing transaction frequency or average sale by, say, cross-selling, upselling, bundling, unbundling, a whole pile of different strategies that you can implement, you will tap your clients out because you'll get to that price where a lot of them start complaining because it's just the price that's going up. Met a lawyer yesterday that told me his accountant, what did he say, Chris? His accountant is really good at doing things for his practice, but not for mine. He's tapped out. He's lost the alignment of value to price. And that's what happens if you only focus on margin. You'll get there. Your current revenue formula that you use by squeezing the orange is that big. That one little box is focusing on margin. Where if you apply your thinking in these areas and focus on your strategies to drive these variables, your revenue plan has got so many other options available for you to have an impact on your revenue. Your current one, what you should be doing. Marketing is this thing that we can't measure. And it's this great black hole of money that just gets wasted. But it's the link between your product and sales. If you don't do it, how do you expect to sell something? You can't. Selling existing products to existing clients. So let's just talk a little bit about existing clients first. Why are existing clients easier to sell to? They've already bought from you. They know what to expect. And why is it easier to sell an existing product to an existing client? They've already bought that product before, yeah. So they know why. It's second easiest to sell existing products to new clients. You know what you're doing. You got war stories, you've got experience. Got to find the new clients, but you don't have to create anything. Thirdly, selling new products to existing clients is easier than selling new products to new clients only because you've already got a relationship with them and you've got the trust. People would have heard the term low-hanging fruit. It makes sense to focus on selling existing products to existing clients first, then existing products to new clients, and then we worry about new products. But until every one of your clients has bought every one of your products, or you've at least spoken to them about every one and marketed every one of your products, you're leaving revenue on your table. You're missing the opportunity. And it's because we love the hunt. Because it's always more fun to go and find a new client than to provide an existing product to an existing client. In your businesses, you're going to have three types of revenue. Every business is the same in the professional services world. The percentages that go into each bucket will be different. So you'll have recurring revenue. Okay? Recurring revenue is revenue that recurs. It's revenue that happens every year. It's like a retainer. In my game, it's our compliance work that we do for clients. We have to do financial statements and tax returns every year. It's recurring revenue. In my game, most accounting firms don't view it like recurring revenue. They still use the squeezing the orange methodology. In our firm, we fix price and clients pay us by month by month over 12 months, because it's a recurring revenue. They have reactive revenue. That's the revenue that just walks in the door. That's a revenue that is client initiated, that they have a transaction so they come and see you about it. They need something done. Then there's proactive revenue. And what I call proactive revenue is the revenue that you do. It's the revenue that you create yourselves by your activities. So with recurring revenue, you can control it and you can quantify it. So when I say you can control it, what I mean is that you have at your disposal the opportunity to say how much and how often, if you have an opportunity for generating recurring revenue. And you can quantify it because you know how much it's going to be every month or every quarter. Reactive revenue. You cannot control reactive revenue and you cannot quantify it. Proactive revenue, you can quantify and you can control it. So what you can control are the activities that you're doing that produce the revenue. And you can quantify it because over time, as you improve your skills and your processes around your proactive revenue activities, sales, marketing, product, you know what the outcomes will be that you can expect. So you can actually predict with a little bit more certainty, not guaranteed, but predict with more certainty that revenue will walk in the door. Majority of your revenue coming from reactive style activities, meaning just doing the work and walking in the door, you are planning, the planning that you can do is minimal to produce that, because your activities that you drive don't have any outcomes because you can't control it. Whereas if you're focusing on the things in your business that you can control, so can you control what your product definition is and what your product is? Can you control what marketing activities you do? Yes. Can you control how you sell? Yes, you can. So if you focus on those activities, which is what the key activities are to get the work into the pot so you can start doing it, doesn't it make sense that you're spending a lot more of your time in the world that you can control? So what can you control? You can control your product, you can control your marketing, and you can control your sales. Product. What's your product? What are you passionate about? What are you good at? And what if you just did that? So we're going to spend some time in a minute defining your product. You're going to actually work out what your product is in your firm. And the reason why you need to define it is so that you can communicate your message, because it's what drives your marketing, and it creates client need awareness or prospect need awareness. You've got to remember in your practice, you cannot be all things to all people. As soon as you think you need to be, you will lose profitability because you're doing too many things, juggling too many balls, wearing too many hats. Number one reason for finding it difficult within partnerships to drive strategic actions is because there's no product definition. And it doesn't, particularly where you've got complementary services or complementary products, areas of law, or areas of law that can feed each other. When there's product definition around that, it allows cross-selling to happen so much easier. It allows the picture of what a client looks like and how you service them becomes so much easier to work out. So the key of having a clear product definition is you're able to then build sales processes off it. You're able to drive marketing. You're then able to build more product, come up with more ideas to keep that spinning. When do you turn your marketing tap off? Never. When do you turn your marketing tap on? When you start your business. It's the only two on and off. But what happens in most businesses? They're a bit busy and they turn it off. And then when do they turn it on? When they're crook or before they're crook? When they're crook. And how long does that marketing tap take to start flowing in? And then what happens? It's right. So you turn it off again because you get busy again. And so you're living in this reactive world. Okay, you're getting this reactive revenue coming in the door. So marketing is something that it's a tap that you don't turn off, but sometimes you might turn down. Okay? But it's something you never turn off. If you are focusing on around getting new clients, so if you're a business that requires new clients to come in the door, you must know who your prospects are. So you've got to think about how we're going to find that out, and then how we're going to market to them. One key piece of advice that I can give you around marketing: engage an expert. I'm not one, okay? But engage an expert with marketing, because they live in a different world. But unless you've got, in a nice way, Kate, but unless you've got clear product and clear sales plan, they won't be able to help you. They'll get some brand awareness happening for you, but that's where it'll stop. So when I say sales, how does that make you feel? Sales. What do you think? Sales is what makes the money. Sales is what brings it in the door, because all sales is a process. And this is what people don't get. Most people, when they think of sales, is that they've got to go and manipulate people. You've got to go and speak a few untruths to get them through the door. Well, it's not. Sales is a process. And when you view sales as a process, just like any other process in your business, you'll see how powerful it is to hit you those numbers that you need to get. So when you do some legal work, do you do a process? When you write a will, do you take on a family law matter? You have your personal injuries firm. Do you follow a process? Yeah. So that's all sales is. Sales is the key between the inquiry that comes in from a prospect or a client and getting the work into your office to be doing. So the key to controlling proactive revenue coming into your business is to control the sales process every step along the way. So you've got to understand how somebody has inquired, and then you have a program or a process to take them through to the end. Okay? So this is just an example of a sales process. So basically you get an inquiry. And at that point of inquiry, what you need to do is you need to determine whether or not you're going to allow that person into your sales process or not. Every step along the way, just gave an answer there. Every step along the way, you need to make sure that this person is appropriate, or this firm is appropriate to go to the next step with you. If they're not, you need to cut them loose, because they will eat up an incredible amount of your time and energy. So you get an inquiry, and what you do at that inquiry is you qualify. And your only job at that first inquiry stage is to do one of two things: let them loose or bam fam. You need to book a meeting from a meeting. So the only way to control a sales outcome is to control the process, and the only way to control a process is to keep it moving. So you get an inquiry comes in, you've qualified them, there's somebody that, it might just be over the phone call, always over the phone if you can, never via email, because you can't sell on email. You provide professional services, and that means you need to have a professional relationship, talk to the person. So you make an inquiry, you qualify them, and then you book a meeting with them. in some way, shape or form. You may have to have a few different meetings depending on what your product is you're selling, what your area of law is, before that person gets comfortable to buy. So you might need to you've got to build a relationship. And most people are in a hurry to get to here. The worst thing you can do in professional services is be in a hurry to close a sale, because it's all based on trust and relationship, and you can't do that from a single meeting. The more energy and effort that you put in to building a relationship with clients, the easier the close will be. So you have a meeting, and at that meeting, when it's time to talk sales, you need to ask, you've got 3 things you need to know. You need to know what their objectives are, what their measures are, and their values are. We're going to come back to this in a minute, because it's one of the most important pieces of sales. You need to know what that is. Then you'll bam-fam. You'll then book another meeting to present your implementation plan to them. What do you guys do with your cost agreements? Mail? Email? Anything that's maybe over, I don't know, set yourselves a limit, like anything that's over $5,000 is delivered in person. It's harder for someone to say no when they're looking you in the eyes. We're talking sales here, guys. It's about an emotional process and an emotional journey. So you deliver them. Never email, never mail, unless you absolutely have to. And you book then you book another meeting to close the sale. If you can close it when you present it, fantastic. But if you can't, you book another meeting too. Because the reality is they're coming to you knowing that they're going to buy from you. They're not going to come to you with a view to say yes or no. Anybody who gives you a call has actually, within themselves, found a need. They're calling you for a reason. What you've got to do is you've got to get the clarity around that and then close the deal around price. But if price is aligned to value, that sale, that closure is so much easier. So 3 killer sales questions. It's somewhere along your sales process, you got to ask these questions. What are your objectives? What is it that you're wanting to achieve? What do you want to, because it's not about what you think they need, it's about what they think they need. And if they don't need it, it's your professional role to tell them that's not right for you. But you've got to know what they need and what they're wanting to achieve before you can actually help them out. They need to know when they know they'll achieve it. Sorry, you need to know when they know they'll achieve it. So what is the defining point where they know those objectives have been met? And lastly, what will it mean to you? What's the value? What's the value question? And it's not around price. What will it mean to you if you can achieve those objectives? Because that's the piece that sells it. The value. Not about your value, it's about their value. If you can quantify that value, even better. But sometimes it's just around peace of mind. Sometimes it's because I've got to get that husband out of my life. It's keep me out of jail. It's, get me as much compensation as you can. Get my life back in order. Whatever it is, there's a whole bunch of reasons that are the value piece. And you should never present anything to a client or out engaging them until you understand what those 3 things are. It's a process of qualification and driving them through a funnel via a process so that they drop out the bottom in dollars, and you're not trying to spend your time with everybody trying to convert everyone, because some people just don't get converted. You create a process that works and you never deviate from it. The sales I lose are the ones that I deviate. For some reason I get a bit of a brain explosion and do something a little bit different. And it's harder to then recover. But I've got a sales process that's tried and tested over the years that I know if I follow that and I have patience and I get them engaged within how we do things, the conversion rate's extremely high. The key to sales management is keeping a list. We've got to keep a list for sales. So we've got to know who's calling us, where they're up to in that process, and how far away we are from closing it. Because if we don't, we forget about it because we get busy. And we've got to look at that every week. So bringing all of that together. First thing is you define your product so you know what you're selling. Then you have a bunch of marketing activities and keep the tap running so that you've got lots of opportunities and leads that are dropping into your pipeline, into your funnel. These leads come in, you qualify them, turn it into an opportunity, keep taking them through a sales process so that you close the deal and the dollars drop out the bottom. Make sense? Then you got to get paid. In terms of getting paid, I call this thing the cash gap. And it's the period of time between when you sign a costs agreement with a client and when you receive the cash. Okay? And the shorter the period of time between when you sign a costs agreement and when you receive the cash, the better your cash flow will be. The more regularly you receive cash along that process, the better your cash flow will be. But what a lot of firms do is they'll sign a costs agreement, period of time later, start the work, finish the work, send a bill out, wait to get paid. Some of them might do some interim billing along the way, but that period of time there, just in this example, is 105 days. So in that cycle, well, not most, for all law firms, most of the costs that are paid for are on a cash basis, not on a credit basis. You pay your rent at the beginning of the month for that month. You pay your wages as they're going. You know, your employees don't have credit terms, but you do. So what you've got to do is you've got to think about your own systems that you've got in your business and what have you got to do to reduce that cash gap. In this business here, what would they have to do to reduce that cash gap, to get it down to say 75 days? And the answer to that is it's in your costs agreement and it's in your processes that you follow up. And it might be something like this, that what you do is you get a costs agreement signed, but as part of your agreement you say to a client, how our process works is that we issue you for a fee of 25% of our estimate at the time we commence the work. You can pay that on our normal terms and we'll put that into our trust account so that when we've done that work, we'll draw it out of there. And you might do that a couple of times. You might have a second interim fee and then you might have a third interim fee, or you might, however you want to do it. But by doing that, it shortens the period of that cash gap. Then what you do is, once you commence the work and you've received the cash, you draw it out of your trust account, at least on a weekly basis. Maybe issue a second fee, receive the cash, finish the engagement, final bill, receive the cash. The key to this is working out what's right for your cash processes in your business. Most cash collection processes and cash management processes in firms is as a result of Chinese whispers, just how we've always done it here. But if you want to get a different result from a cash perspective, change your process. How you engage your clients at the very front end defines what the outcomes you will achieve in your business through that engagement. So you summarise it for them in a simple covering letter that's written in plain, simple language. And what you want them to know is that this is how much we think, this is how we're going to bill you, and this is how you're going to pay us. That's what you need them to know. Because then, if they sign that agreement, this turns into an administration function around how you process your billing in your firm. Raise a fee at different intervals. Put it into the trust account. Follow up your debtors weekly. Making sure you're constantly... Because what you've got to remember is somebody signed a document that said, I agree to your terms. People actually expect this. The reason that they don't pay is because we let them get away with it. You've got to say, the time between when the client says yes and when that job's finished and I get the money. And you've got to squish that up. Someone's more likely to buy from you if they've got a feel for what it's going to cost in a dollar amount than that being an unknown. That's when price counts. If they know, they can make an informed decision. If they don't know, it's harder for them to sign. But just pulling it all together. First thing is, you got to set some goals, right? Because if you don't know where you're heading, you can't work out how you're going to get there. Second thing is, you got to do something different, okay? You actually have to do something. If you don't do something, it's great to have all this information, but if you don't do something, you're not going to get any different result. Then you've got to define what you sell. So unless you know what you're selling, you can't sell it. And you've got to get a tap turned on for marketing, and you've got to keep marketing. You've got to constantly be marketing. You've got to create a sales process that you follow religiously, that you can test and assess how well it works, so that you can then produce predictable outcomes from the inquiries that come in. And then you need to design your cash flow, and the cost agreement, your process of cost agreement is the key. The better you do this process at the beginning, before when a client signs up, the easier it is to manage all of your cash flow, your WIP days and your debtors days.
Oh, lots of practical ideas for me to take back. I'm from Melbourne, so I'll be flying back thinking on it all, and then we'll be working with the practicalities of all the input. So there was some theory, but it's more the practical application that now becomes quite exciting.
I think the emphasis on the marketing and sales, the distinction between the two is an important one. It's not something that lawyers really appreciate or understand, and I think that being able to link the two the way Matt's done is a unique thing.
I haven't been to a seminar like that before from an accountant, and he obviously knows his marketing stuff, so that was useful for me. So yeah, definitely recommend it.
Today was just absolutely valuable for me. Learning how to market to the legal industry, I think, was the key takeaway for me today.
It exceeded my expectations, so well worth the trip.